Good morning. Welcome to Market Monday for March 31st, 2025. The author F. Scott Fitzgerald once wrote that the test of the first-rate intelligence is the ability to hold two opposed ideas in the mind at the same time and still retain the ability to function. This concept is particularly relevant for us as investors, as we must navigate the tension between short-term market fluctuations and long-term financial goals on a regular basis, especially in today's uncertain environment. Markets can swing dramatically in the short run, even as they tend to rise in the long run. Investor sentiment can shift overnight, as seen several times in the recent months. An underperforming sector, investment style, or asset class can suddenly surge to the top, while previous market leaders fall out of favor. Meanwhile, the economy often provides mixed signals and can seem contradictory, especially when fiscal and monetary policies are shifting in response to evolving conditions. That's why we're always so focused on history and context, to provide you with a broader perspective and to ultimately be better investors. The stock market has stumbled after two exceptional years. The S&P 500 recently fell into correction territory, led by declines in the NASDAQ and major technology stocks. While tariffs sparked this latest wave of volatility, investors are now concerned about a possible recession. Given the headlines, it's not hard to see why some investors are nervous. Yes, it's true that bonds are still in the longest bear market in history, but they're climbing out of this right here and have actually had positive total returns for the last 2 years and change. For many investors, concerns around economic policy have heightened fears of a potential recession. This issue has become a major talking point again in 2025, with investor sentiment falling near record lows, according to the weekly AAII Investor Sentiment Survey. One interesting way to visualize this market concern is through the Economic Policy Uncertainty Index. Wow, see that? The current levels are in the same level as COVID, when the world literally shut down. Understanding that current market swings are driven by policy uncertainty rather than actual economic weakness can help put recent volatility in perspective. The situation can often improve once uncertainty is lifted and concrete policies are implemented. It's understandable that in this volatile environment, investors are retreating to the perceived safety of cash. And unlike stocks or bonds, cash holdings appear stable, offering a sense of security. However, this safety is often an illusion when viewed through a long-term financial lens. This is a hidden cost when investors seek the safety of cash. The balance on a bank statement or money market may feel safe since it's stable, unlike the fluctuating value in an investment account. However, what truly matters isn't the dollar amount of cash, but what it can purchase. Over time, inflation reduces the purchasing power, meaning that the same number of dollars buys fewer goods and services each year. Thus, portfolio growth is needed to maintain an investor's purchasing power, let alone create real wealth. After several years of strong U.S. stock market returns, recent volatility has reinforced the value of maintaining exposure to all the asset classes. The year-to-date rotation in performance across asset classes illustrates why maintaining exposure beyond large-cap U.S. stocks is essential for long-term financial success. When U.S. stocks face headwinds, other investments often provide offsetting returns that help smooth the overall portfolio experience. So far this year, international stocks, commodities, and fixed income have helped to offset stock market swings. And admittedly, this is a lot easier said than done, as we can clearly see large U.S. stocks like the S&P 500 have most of the past 15 years as king of the hill. All this to say, investing this way is simple, but not easy. And we promise there's a reason we encourage most investors to stay invested. Here, we're looking at $1,000 invested over a 25-year period. And here's what happens if you literally do nothing. And the rest is what happens if you get out the market after every 2% drop and stay out for 1 week. 2 weeks, a month, a quarter, and a year. The longer you stay out, the worse your returns have historically been. Which reminds us of the old investing adage. It's time in the market, not timing the market. Have a great week.